Hi, class. Today's topic is deferred taxes. Definitely not one of my personal favorite subjects. I'm not a tax person. So if you're planning to go into tax, you need to really understand this material and pay attention here. And it's kind of a head turner a bit because you've got to know book income, meaning what we're doing in financial reporting in this course, how we are recording net income, how we're recognizing liabilities, recognizing and depreciating assets. And it's different on the tax return. And so you have to know the financial reporting side, and you also have to know the income tax side. So if you've had an income tax course already, that'll make it easier for you. If you've not, you'll have to kind of think through this, and we'll try to help you with what's on the tax return. We keep it simple on the tax side. We only look at a few differences here. And so if you want to think about it, this is all about accrual accounting, because we may recognize expenses on the financial reporting side, but we don't recognize them on the tax return. However, later we're going to get a deduction on the tax return for those items that are recording as an expense on the book side. And so we need to go ahead and recognize that deduction now, because this is accrual accounting, knowing that we'll save money, cash money on taxes later. On the other hand, we may have greater deductions, especially for depreciation expense. Tax returns allow accelerated methods of depreciation where we may use just straight line on the financial reporting side. Therefore, we may get big tax deductions now, but we're not recording expenses like that now. We will pay less taxes now, but end up paying more taxes later. That's nothing more than a deferred tax liability, because we'll pay taxes later. So this is about timing. And those two examples I just used, they're called temporary differences, meaning there's an item on our books now that will reverse and be on the tax return later. Or there's something on the tax return now that will be reversed. It'll be on financial reporting later. So for all these differences, temporary differences, we're going to recognize deferred tax assets and deferred tax liabilities, and it will impact the tax expense we record on financial reporting. Now, there are permanent differences, things that are never reported on the tax return, even though we report them on the books. That's easier. We just don't record any tax impact for those items because they're permanent in nature. They will never reverse. So these temporary differences, these deferred tax assets and liabilities we're going to talk about today, and I'm going to work problems around, are all related to temporary differences. And with that, I'm going to share my screen and we're going to get started here. Well, don't want to see that. Here we go. Let me get this up here. Oh, there you go. This is my kind of one-page summary of deferred taxes, if you will. And if you're in my class, you will receive this. So, but if not, maybe you can take a picture of it now on screen. But this is the way I personally look at it. And the textbook may have a different kind of approach to it, and that's fine. I look at a comparison of taxable income versus book income. If the taxable income is higher, that means, hey, we're paying more cash taxes now for the temporary items than the book items. Isn't that like a prepaid? Because we're paying more taxes now, but we'll pay less taxes later. That is a deferred tax asset. Future deductible items. An example would be we'll look at this. An example would be what's like a prepaid expense, as I said, and we record tax expense later on the books, but we record a deferred tax asset now. So that's a difference from the tax return. Now, what are some examples of DTAs? Warranty, inventory, contingency reserves. For these items, on the tax side, these are more cash basis items. The tax authorities generally do not allow us to record big warranty reserves and take deductions for those. Otherwise, companies might start estimating very large warranty reserves in order to get tax deductions. So on the tax side, they say, hey, yeah, we'll give you a deduction for warranty when you pay for it. However, as you know, from looking at current liabilities and contingent liabilities, we record those expenses now. We do estimates of future cash payments for these liabilities, and we record an expense now. But we do not get a deduction on this year's tax return for those items. However, we know we will get a deduction in the future for those, so therefore we go ahead and we reduce income tax expense for those items, and we record a deferred tax asset. Now, deferred tax liability is the other direction. Taxable income is less than our book income. One of the biggest reasons, which we'll get into, is tax authorities allow an accelerated depreciation expense methods. And generally, in any of the companies I've ever worked in, it was always, we always use straight line basis for financial reporting and accelerated methods for tax returns. So therefore, we're getting these big deductions on the tax return for depreciation expense that are not showing up on our books. So the tax return is lower. We're paying less taxes now for these items, but in the future, compared to the book side, we'll pay more taxes in the future. We have future taxable items. In accrual accounting, doesn't that sound like a liability? Because we will pay more taxes in the future? Yes. And so we record tax expense on the book side as if that was how the tax return handled it, and therefore we will have higher tax expense than what the tax return says, and we'll have a deferred tax liability. So I like to look at it in comparison, tax income versus book income, and both sides. So I think this is a simple way to do this, and you have to think about it. Now, one other thing here, and this is, by the way, this current tax method is called the balance sheet method, because we can just calculate the ending balance for deferred tax asset or liabilities by looking at the book basis versus the tax basis. For example, let's say we have a $50 million warranty liability at the end of the year. What does that represent? That represents 40 million of future cash payments we're going to have to make. All cash payments already have been made in the past have reduced the liability. So therefore, we could just look at that warranty liability and know it represents all future deferred tax asset items. Multiply that warranty liability times the tax rate, and you've got your ending balance of the deferred tax asset. You go back and you look at what your beginning balance was, and you'll book the difference in your calculation of income tax expense. On the other side, property, plant, and equipment will normally have a higher net book value in the earlier years, because we're depreciating those things at much faster rates on the tax return. So therefore, if we look at the book basis of a particular asset, it's generally going to be higher than the tax basis. We can look at that difference, and that difference represents all the future taxable items. So we take that difference times the tax rate, and we calculate the ending balance of the deferred tax liabilities. Kind of a shortcut method here. Then looking at each item on the net income and the tax return side, we can just go to the balance sheet and we can calculate the ending balance of these deferred tax assets and liabilities, and we will book the change in those as part of our calculation of income tax expense. Now, finally here at the bottom, when you have an asset, you may have an issue. You always have to think, will we ever realize this asset? And there are cases, and we're only talking about deferred tax assets here. Some deferred tax assets are not going to be temporary differences because we'll never get the future tax deduction. What are some of the reasons for this? The biggest reason is you have operating losses for many years, and therefore you cannot assume that you'll make money, enough income in the future to ever be able to record that tax deduction and get that tax deduction. And this goes jurisdiction by jurisdictions. I know in one of the companies I worked for, we had very large losses in England, and we weren't doing that much business in England anymore, but we had some deferred tax asset items in England, but we knew we would never be able to realize those. And so we had to, it was more likely than not that we would not realize those. Therefore, we had to do a contra asset account, record a credit in a contra asset account to reduce that deferred tax asset. And that contra asset account is called a valuation allowance. Any change in the valuation allowance, debit or credit, is 100% offset to income tax expense. So, and then finally, we talked about permanent tax differences, the items on the books that will never be recognized on a tax return. We do not record any DTAs or DTLs on for those items, and basically we just ignore. There's zero tax expense or benefit for permanent items. So just keep that in mind. So everything we're going to talk about today is going to be about temporary differences. So with that, let's go work some problems here. And we'll start here with exercise 16-1. If you are brave here and you want to take a stab at this, go ahead, pause the video and try to work this, and then we'll come back and take a look at it. All right, welcome back. Let's take a look at this. So we have pre-tax accounting income 400 and a taxable, this is accounting income, book income of 400, taxable income of 250. So we have $150,000 difference, and no temporary difference existed at the beginning of the year. So this 100% came about in this year. So therefore, taxable income is lower. Just gonna pull out my cheat sheet and make sure I don't screw this up, because I will not want to do this later. And so taxable income is lower. Therefore, we're gonna have in the future, that 150 will reverse, and we'll have to pay taxes on that in the future. What does that sound like? Not a prepaid, sounds like a liability. We're gonna have to pay more in the future. So we're gonna have a deferred tax liability for that $150,000 difference. Now, calculating tax expense is basically a 3-step process. 4 steps if you have a valuation allowance. In this case, we don't. So step 1, go calculate the tax payable. And the tax payable means, when we end the year in 12/31, we do not have to pay taxes until we file corporate tax returns are due March 15th. We might be able to extend them. And so we're going to have a tax payable at the end of the year. And so that tax payable is going to be based off $250,000. And that's the taxable income on our tax return. And we're going to have to pay 35% of that is a tax payable item. So let's go calculate that. 250, 87,000, 500. Make sure I got that right. 250,000. So I'm gonna have to credit. I got a tax payable, 87,500. Number 2, I've got a deferred tax liability. I'll always use DTL for deferred tax liabilities, and that's equal to 150,000 times 35%. Equals 52,500. Step 3, we could just go do the journal entry at this point. Debit income tax expense, and it's just going to be basically a plug number. We'll go put our credit into our DTL, and that DTL is equal 52,500, and we're going to credit tax payable, income tax payable, 87,500. What is tax expense? $140,000. Okay. Again, step one in every one of these problems, calculate the tax payable. That's the tax return amount, income, times the tax rate. That's how much we're going to have to pay, 87,500. Step two, and I'm going to say it this way, look at the changes in the deferred tax assets and liabilities and record your debits and credits for the changes in DTAs and DTLs. And those changes, we calculate those out, and we'll do put those into our journal entry. And then income tax expense is just a plug number, whatever debit is required to make our debits and credits equal. And so here we had $140,000 of credits, and therefore our tax expense was $140,000. And then this problem asks for net income. Well, we have pre-tax income of 400,000 minus tax expense of 140,000. Net income equals 260,000. Now the problem also asks what's going to show up on our books, what's going to show up on the balance sheet. We're going to have a deferred tax liability of 52,500, and we're going to have a tax payable of 87,500, and then therefore tax expense of 140,000. All right, guys, let's go to the second problem here. See, this is an easy one, and take a look at this one. See if you can record this journal entry for income tax provision with these problems here. Pause the video. Try to work this on your own. We're going to move this up here. All right, step one. Let me sharpen my pencil. Calculate the tax payable. And so that's the tax return amount. What is our taxable income of 75 million? So 75 million times my tax rate, 40%. So my tax payable, I think that's going to be equal to 30 million. I don't even think I need my calculator for that. Step two, changes in DTAs or DTLs. In this case, we only have a deferred tax asset. And so here we go. We had a deferred tax asset of 435 at the beginning of the year. So we start with 435, and in this case, we're going to use the balance sheet method, and we'll go calculate the ending balance. And so we have a warranty liability of $1 million. We know that that warranty liability represents all the future cash payments that will be made. And on the tax side, well, we only get a deduction when we actually pay for warranty liability. So this 1 million is all the unpaid warranty expenses that we've recorded on the book side. So it represents maybe not just this year. It could be if we had a longer term warranty, it could go back in time. At Lennox, we had a 20-year warranty on heat exchangers, sometimes lifetime. So we had $75, $80 million warranty liability at any point in time. that represented warranty expense over the past 10, 15 years that just had not been paid yet. And if we say it's not been paid yet, means we haven't taken a tax deduction on it yet. So that all that million represents the ending balance of the deferred tax item. So I take that 1 million that I know I'm going to get future tax deductions of $1 million here for warranty liability when these warranty claims are paid, and we take a tax deduction only when they're paid. So how much of that will we get a cash benefit of? It will be $1 million deduction times the 40% tax rate. So therefore, $400,000. So that equals my DTA. And what is it? It's the ending balance. I started with a beginning balance equals 435 million, and that's a debit. And I need to get to a $400,000, so the change is going to equal credit to DTA of 35,000. In other words, how do I reduce a $435,000 debit balance to 400,000? I've got to credit that account. So there we go. I've got my two parts of my journal entries, and I'm ready to go. Number 3, journal entry. Debit income tax expense. Don't know the answer yet. I've got to credit my DTA. Even though a DTA is normally a debit balance, this is the change, and that's going to be $35,000 credit. My tax payable is 30 million. And so there is my two items. So what is my income tax expense? 30,035. Okay, we got that, guys? All right, let's go to the next problem. (16-11). For this one, just do number 2. We're gonna look at we're gonna throw a valuation allowance in here, and so steps 1 through 3 that we've been doing here do not change. At the end, you got to record the change in the valuation allowance, and that change, that difference, is dollar for dollar impacts income tax expense. So the fourth one will be a new journal entry that records the valuation allowance. Pause the video, go work this, and then come back. All right, here we go. Well, that's step 1, tax payable. That's going to be equal to, what's my taxable income? Here we go. Taxable income is 180 million. And I'm going to multiply that times my tax rate, 40%. And 180 times 40% equals 72 million. Let's just check that. 72 million. All right. Item number 2. Okay, let's see what we've got here for temporary differences. Okay, we had a deferred tax asset account that started with 30 million, attributable to a book tax difference of 75 million. Okay, at the end of 2018, that 75 million has become 70 million. And so we know it's a deferred tax asset because they tell us that in this case. I will be a little bit tougher on that on any exam that I do for you. But here we go. I've got ending balance of DTA is going to equal 70 million times 40% equals 28 million, right? So there's my 70 million on my deferred tax asset item. So it could have had a big warranty liability or a contingent liability sitting out there. It's 70 million, it's changed. Maybe there were some payments against the warranty and it's dropped down from 75 down to 70. So we're at 28 million. What do we care about? Well, this is going to be the ending balance that goes to the balance sheet. What do we have in there now? We have how much? It was 30 million. 75 million times the same 40%, it was 30 million. And that's a debit balance because it's an asset. So what do we need? We need a $2 million credit to DTA. Hopefully you guys see how that works. So it's the change because on our balance sheet at the end of this year, we're going to have a $28 million deferred tax asset. And, it used to be 30, so we got to drop it down by 2 million. Step 3, easy stuff, journal entry, debit income tax expense. We don't know the answer to that. Credit my DTA for 2 million and credit my tax payable for the 72 million. What's tax expense? It's whatever debit I need to make my debits and credits equal. 72 plus 2, 74 million. We're not done though, because now we have the valuation allowance. And that is against the $28 million. So the DTA equals 28 million. And it tells us we had 10 million at the beginning of the year. So now we're going to go calculate the ending balance. And we're going to do item number 2 here, which says 1/4 of the deferred tax will ultimately be realized. How much will not be realized? 3/4 or 75%, right? We're going to, this 28, we're confident, more likely than not, that we'll get 1/4 of it. That's only 7 million of it, but 21 million, we do not believe we're ever going to be able to take a tax deduction on. So we have to reflect that valuation allowance on the balance sheet as a contra asset account. It'll be disclosed in footnotes as well. And so here we got to go. We got to say beginning balance for the valuation allowance. What did that equal? 10 million. All right. And that is always a credit balance. But we need to go to how much? 21 million. Need credit of 11 million. Therefore, so we're going to have to credit the valuation allowance for 11 million, and the offset's always to income tax expense. Okay, what was total income tax expense for this company? 74 million plus 11, 85 million for this year. Again, step 1, calculate your tax payable, tax return times the 40%. Step 2, calculate any changes in DTA, DTLs, then record those changes. And in step 3, whatever the plug number is for income tax expense, I'll reflect that as a debit to income tax expense. And then step 4, any changes to the valuation allowance also will affect income tax expense. All right, I bet you guys are experts now. So let's go do one more problem here. And let's see, I don't think there's any valuation allowance on this one, so that make it a little bit easier for you, a little bit quicker. And I know you guys will you're going to be experts and just knock this out. This is exactly like what I would put on an exam, a problem very, very similar to this. We haven't talked about prepaid insurance now, so you have to think about it. I will let you know that for prepaid insurance, again, the tax return is going to be on a cash basis. So when we pay cash for insurance up front, on the book side, we record it as a prepaid. On the tax side, they record it as a tax deduction. So I'll give you that piece of information and then let you think about whether that's a DTA or a DTL. Again, pause the video, work this problem. All right. Let's see if you don't need that information. Let's see what I got to get as much of this as visible to you as possible here. All right. Step 1. What's the tax payable amount? And that's the tax return amount. Taxable income was 145 million. So 145 million times the tax rate of 40%. And that's equal to 58 million. Don't miss that step on any exam. Now, step 2, we've got both DTAs and DTLs here. So let's look at this. So we've depreciated buildings and equipment for 120 million. I mean, the net book value is 120 million on our books, but it's only 90 million on the tax side. That means over time, we have recorded $30 million more of tax depreciation expense on the tax return. Therefore, over time, the tax return has been lower, but this will reverse. Therefore, it will pay more, will have higher income tax for these items in the future. That's a deferred tax liability and equals to 30 million. These are all millions. Prepaid insurance, we also got a deduction on the tax return. So the tax return was lower. We haven't expensed these things on the books later. We'll expense them in subsequent periods. So just like that, that's also a 50 million deferred tax liability. And then 25 million for a loss contingency. That one is the opposite. We have expensed that on the books, but we haven't expensed on the tax return. So the tax return has been higher over time because of this. And we've paid taxes already on these items. And we'll have less taxes in the future, deductions. And so that's a 25 million DTA. So let's go do DTLs first. This is ending balance. It's going to be 80 million, right? I've got 30 plus 50 times 40% tax rate. My ending balance on deferred tax liability is 32 million. What's my beginning balance? They tell us that? Oh, there were no temporary difference in the beginning of 2018. Oh, that's easy, equals 0. So we've got to do a credit to DTL of 32 million. Are we done yet? No, because we have a DTA. And so DTA, ending balance, we only have one item, a $25 million item, times 40% equals 10 million. beginning balance equals 0. So need debit of 10 million. Step 3, let's do our journal entry. Debit income tax expense. Don't know the answer yet. I got another debit here of 10 million. And I've got a credit to DTL of 32 million. And I got a tax payable of 58 million. And so what is my plug number here? I've got $90 million of credits, $10 million debits, so I need 80 million here. Now I have $90 million of debits, $90 million of credit. Tax expense equals to 80 million. Now this problem also asks us, what is the net income? That would be a good question. Also, pre-tax income, this is on the book side, equals 200 million. Tax expense, 80 million. Net income equals 120 million. And there you go, guys. That's some deferred tax problems for you to look at. You can go back and play this video again and try to work these on your own. If you don't understand any of these, and you should, regardless, be pulling out the textbook, to follow and make sure you understand the logic behind these. Any multiple choice questions will get to the logic. So, all right, guys, thank you for being engaged in this video.